Hi, I'm here with Pete Johnson, a lender at GreenState Credit Union today to talk about buydowns. Now, buydowns are a thing that apparently were quite a technique that has been used in the past in the 70s and 80s, and then again, maybe about 15 years ago. But because we've been in such a strong seller's market for quite a while, it's not something that uh, newer agents or home buyers who haven't been around for forever, it's not something that they may know about. So I wanted to bring Pete on my channel here today to talk about buy downs. So Pete, can you give us just an overview of what is a buy down?
Yeah, absolutely. Buy downs aren't quite as complicated as they sound. What it really is a discount that's typically paid for by the seller of the home to discount your rate for the first 1, 2, 3 years. There's typically three versions of this. There's a 3-year buy down, which will give you a discount on your rate for 3 years. A 2-year then would be 2 years, and then 1 year would be a single year buy down where your interest rate is temporarily lower. So for example, if today's interest rate was 6.5% normally on a 30-year fixed rate, which is fairly close, your first year on a 2-year buy down, or a 2-1 buy down is what we call it, would be 2% lower. It'd be 4.5%. And then in year 2 of your loan, out of 30 years, typically you're doing this on a 30-year loan, your interest rate would be 1% lower, 5.5, and then in year 3, it would go back to the regular market rate of 6.5. So it just gives you kind of a temporary discount until we get to the end of the buy down, and then it goes back to the normal rate.
Cool. Okay, so buyers are very familiar with things like closing cost credits or a reduction of the overall purchase price. When a buyer goes into negotiations, they're trying to buy a house, they're used to the idea of, oh, hey, I want to ask the seller to pay for my closing costs, or I don't want to pay $300,000 for that house. I want to pay $290,000 for that house. But a buy down is another, let's just call it a tool, another tool that can either be viewed as a benefit to the buyer or even a benefit to the seller in the process of trying to bring a deal together. Pete, can you explain to my viewers what is the difference between points and a buy down? They seem very closely related.
Yeah, absolutely. So when you pay points, a point is equal to 1% of your loan amount. So if you had, say, a $320,000 loan, a point would be equal to 1% of that in additional closing costs you would pay to your lender to buy the rate down. So what you're doing is you're agreeing to pay an additional $3,200 in that case, 1% of the 320, to get a lower interest rate. And a point, it will sometimes buy you 1/8 of a percentage point, typically about 1/8 of a percentage point, or 0.125%. Sometimes you might be able to get it as low as 0.25%. That changes all the time. You got to ask your lender every time when you get a purchase agreement put together what that dollar amount is. But that will permanently reduce your rate. We call that a permanent buy down, where you're paying points or fees, additional fees, to get that rate a little bit lower. And that will last the entire time that you own the home. So if your plan is to be there long term, it can be a good tool to do that. It can save you a lot of money long term. In the shorter term, it may not. Right now, we're in a really high interest rate, or not, I wouldn't say high, but historically high. For the last 20 years, we're higher than we have been, let's say, in the past. Interest rates may come down. And so if you do a permanent buy down, that money's gone. And if interest rates go down the next year, for example, that's money that you may have lost if you decide to refinance. So if you refinance, you're basically paying that loan off. You're starting a new loan at a new interest rate, and the money that was used to buy that rate down permanently is kind of gone. It's non-refundable. Whereas with the buy down, the 2-1 buy down, or the temporary buy down, the rate doesn't go down permanently, but you do get a reduction in the interest rate for the 2 years. And when you go to refinance, that money isn't necessarily wasted because the rate's been reduced.
So to me, a buy down feels like the buyer is basically buying time. I want to have my rates reduced for 3 years, 2 years, or 1 year with the hope that the overall interest rate will reduce to a point where I can refi and just lock into a better rate overall.
That's right. Yeah, your anticipation there is that rates will likely come down. You're going to get an opportunity to refinance, or at a minimum, you're just looking for a discount on your monthly payments for that first couple years, to avoid payment shock, maybe something along those lines.
Yeah.
But the thought process would be that hopefully we'd be able to refinance when rates are lower, and then you haven't committed a lot of money to buying that rate down permanently when it isn't necessary.
So are points something that a buyer usually pays for themselves, while a buy down is something that the seller kicks in for the buyer?
Yeah, absolutely. So a buyer or a seller can technically pay for both. Right now with the temporary buy down, the 2-1 buy down, which is the temporary version of that, typically the sellers are paying for that right now. And again, this changes as time goes by. Sometimes it makes sense for the buyer to pay it if the market is allowing for that. Right now, the market is really only allowing for the seller to pay for it, and it makes a little bit more sense for the seller to pay for it. Anyway, when we're talking about just a permanent buy down or paying points, really either the seller or the buyer can pay that.
Okay. Let's see here. So when you have a buy down, does that impact what the buyer is qualified to purchase?
No. So on the buy down, the temporary buy down, the 2-1 buy down, the buyer is qualified based off the higher rate, and you really want to qualify off the higher rate because eventually that's the rate that you're going to be paying. So anytime you do a buy down, you don't want to be qualifying based off the temporary rate. You want to be qualifying off the permanent rate, in case that is the rate that you end up getting. So.
Okay. When you negotiate a deal that has a buy down, let's say the seller is agreeing to a 2-1 buy down. So they're going to buy down your interest rate 2 percentage points the first year, 1 percentage point the second year. That amount of money will be calculated by the buyer's lender, because we're not going to know that exact amount until the buyer locks in, right?
Right. That's right.
And then who holds that money? Where does the money go?
Yep. Yeah, the money's actually held. And this is one of the nice things about the 2-1 buy down is the money's actually held in an escrow account with the lender. So the amount of money that's being withheld is really just the amount of interest that was being saved in the buy down. And so that money will just be set aside in an escrow account. And the nice thing is if you don't end up using it all, so let's say you refinance 6 months or maybe 8 months or a year into the loan, and you didn't even make it to year 2, whatever's left in that escrow account that's being applied to that interest gets actually refunded back to you, typically gets applied to the principal balance on the loan. So you can actually get some of that money back in the event that you refinance.
Okay. What is the lender's ability to do a buy down? Can any lender do a buy down? Is it specific to certain lenders? What are the rules?
Yeah, it really, I mean, theoretically any lender could do a buy down, but not all do. So you have to check with your lender to see if they've decided to participate in that program. They have it in their portfolio of programs per se. So not all lenders will do it. It's going to definitely be specific lenders that have decided that's a product line that they want to carry.
So that's something that your real estate agent and your lender need to communicate about before it shows up on a purchase agreement and you think you're going to get it.
Absolutely. Yeah, absolutely.
Okay. So you already answered my next question of what happens to the buy down money if you sell or refi before the end of that time period. It just gets applied to your principal.
That's right.
And then what's your role in an offer that has a buy down as part of the negotiated terms? You're the one who comes up with that final price. So, okay, let's say I'm representing the seller and the seller wants to offer a buy down. We don't know exactly how much money that's going to be until the buyer locks into an interest rate. So when you see these things show up on purchase agreements, do they look something like seller shall pay a 2-1 buy down for the buyer not to exceed whatever, $10,000.
Yeah, you definitely want to set it that way. And this applies. 2-1 buy downs are used a lot in new construction where the seller maybe doesn't want to reduce their purchase price. All right, or that reducing the purchase price doesn't really impact the payment much. Maybe there's not as much value in dropping the price. Typically what we'll do is we'll kind of decide how much money they want to apply to a buy down, and maybe we can't get to a 2-1 buy down. Maybe we only have enough funds available for a 1 year, single year buy down. So we'll kind of negotiate that up front, but that would probably be a good way to do it, would be to just limit it in the purchase agreement as to what that number is. Now that dollar amount is really the cost of that 2-1 buy down is dependent on the borrower's loan amount. So it's going to change all the time. It's a little bit tricky because it's calculated based off how much down payment the buyer has, right? So the seller's going to have to limit that when they advertise the property, when you advertise the property in the listing, as to how much money they want to contribute. And there are some limits to how much money the seller can contribute when it comes to the buyer's loan. They can't. There's that dollar amount is not unlimited as well. So those are some of the things that we kind of have to think about. And typically we'll prepare if the seller's thinking about offering a buy down. That's something that we'll kind of talk about up front with the listing agent, and then also the seller, to kind of make sure that the dollar figure that we're using makes sense, and that we're not promising something that we can't deliver, basically.
So if you're a seller and you're thinking about offering a buy down as an incentive to try to reel that buyer in, can the money, that hypothetical $10,000, can it be used a la carte? If you say, okay, I've got $10,000 I'm willing to give up. I don't want to drop my overall price $10,000, but the buyer can use it as a buy down, and then whatever remains can go to closing costs and prepaids. Can it be distributed that way?
Yeah, absolutely. Yeah, you could use that money as a buyer credit, in any sense of the word. So you could use it for any kind of closing cost credit that's allowed. They could pay closing costs with it. Technically, the cost to do the buy down is a closing cost, so it can be applied towards the buy down. It could be applied towards closing costs. It could just be a straight price reduction. Maybe you don't use up all the funds, and we just reduce the price by whatever dollar amount we have left over. So it certainly can. It could also be used to buy straight points, permanent buy down. So you can use it for that as well.
So, I mean, I can definitely see ways in which a buy down obviously benefits a buyer. Sometimes buyers don't understand initially what is being offered to them, and they kind of view it as like, this is some sort of trap. the lender or the seller is trying to trap me into something.
Right.
And,
feels like magic.
Right. Yeah. This doesn't feel like a trap to me. A lot of buyers are suspicious of ARMs, adjustable rate mortgages. They feel like that might somehow be a trap. I could see how this would really benefit a buyer if they are banking on the fact that they think interest rates are going to go back down. So they really need to buy a house. Interest rates right now feel ridiculous to them, and they think, gosh, I think they're going to come back down in the next couple of years. A buy down would be an awesome option because it gets them into an interest rate that feels more reasonable. I could see how it would really benefit a buyer who is expecting a increase in their wages and and how much money they make. For instance, somebody who is a medical resident right now, and in a year or two is, they're going to be a physician, their income is going to increase quite a bit. So the buy down would be very beneficial for them in the short term. Or a buyer who is single income and they are anticipating being dual income. Maybe their spouse is in school and going to be graduating in the next year or two. Buy down could be really valuable to them. In terms of a seller, how would a buy down be valuable to a seller? Why wouldn't you just drop your overall price? For builders, I mean, this one's a no-brainer. Builders never want to drop their price because then that impacts every other new build that they have. So a buy down is a way to respond to market conditions without affecting every single future property you have on that block. For a non-builder, for just your average Joe seller, why would somebody like that consider a buy down? Well, it helps you maintain the value of your neighborhood. If you're invested in your neighborhood and you don't want to impact what your neighbors might be able to sell their house for in the future, a buy down is a good way to maintain that value, but still negotiate with a buyer, right?
Yep. Yep.
Or if we are in a selling environment where it's become much harder to sell your house and you have a lot of competition, how do you make your house stand out from all of the others? Well,
Right.
a buy down. You're making the buyer's monthly payment look much more agreeable. So, Pete, as somebody who talks to buyers all the time and you help people hash through the numbers of their deals, are buyers more concerned with the overall price of the house, or are they more concerned with what their monthly payment number is?
Yeah, I would say monthly payment, especially right now. I mean, price of homes, obviously, in the last few years, with inflation has been a concern, but definitely the rates have come up faster, and that's definitely been a shock to people, especially people who've been pre-approving earlier on in the year when the rates were low, and then they come back, 6 or 7 months later, they found a house and they see that their payment's $300 higher or whatever than we talked about before. Especially some of the first-time home buyers, the younger first-time home buyers, or anybody really that's going to be there temporarily, maybe not going to live in the house for 30 years, which is probably most people buying their first or even their second home. Anybody in that temporary situation, it's definitely payment is the issue. To give you a good example, if you were to go to a seller today and ask them to reduce the price of their home by, say, $5,000 to $7,000, right? That $5,000 to $7,000 is really only going to reduce your payment by maybe $30 to $40 a month. Whereas
I know, that's so disappointing.
Yeah, I know. Right. It doesn't do as much as you think. And people, when they come to my house, they're always super surprised when they say, "Oh, what if I put another $10,000 down?" Well, it's $50 a month, right? They were expecting hundreds of dollars per month. It's only $50 a month for approximately for every $10,000. And so the buy down, they take the same amount of money, maybe $5,000 to $7,000, maybe $8,000, whatever's allowed on the particular deal we're talking about. That might reduce your payment by $300 per month. So it might erase that deficit between what we pre-approved you at before, when rates were in the threes, versus where they're at now in like the mid sixes. And then it might kind of cushion the blow, at least for that first couple of years. And then, like we talked about earlier, we're kind of anticipating, hopefully rates coming back down at some point. Rates are pretty cyclical. Typically, they don't just go up and stay up, they come down. We can't always guarantee that, but wait for that opportunity to refinance. Or if you only plan on being in the house for maybe 3 or 4 or 5 years anyway, it really cuts the cost, average cost of owning that home on a monthly basis down by a fair amount, and makes it a little bit more tenable, a little bit more into the original budget maybe that you had.
You just touched on a really good point. A lot of people go into a home purchase thinking that this is going to be their forever home, and it's just not.
Right.
The people that I encounter stay in their homes maybe 3, 5, maybe 10 years. I can't think of the last time I helped a seller who actually was in the house for 30 years. You want to pay down your points for the whole course of your loan, that's great. But the reality is you would need to figure out the math calculation on where your break-even point is, because you may not even be in the house long enough to hit that break-even point. A 3-2-1, 2-1, or 1-0 buy down seems like the smarter option for the reality of how long people are in the house.
Yeah, and I think it's a great option for right now. It's really the reason you haven't seen 2-1 buy downs or 3-2-1 buy downs, or buy downs at all in the last 10 or 15 years, because we've been at historically low rates. So these were pretty commonplace when I first got in the business a million years ago. We were doing these when rates were back to 7%. When I first got in back in the early 2000s, where rates were 7%. And so it makes a little bit more sense in these higher rate environments, and especially when rates are moving up. It makes a little bit more sense than when we're sitting at 2% and 3% interest rates, which are already a good deal to begin with, right? So yeah, absolutely.
Okay. So he's prepared a worksheet for us where he's going to show us some actual numbers on a spreadsheet. So we're going to pop over to that. And this is an example of a $400,000 loan where the buyer has 20% down. Pete, can you talk us through this scenario here?
Yeah, absolutely. So what we did here is just kind of a simple scenario on a $400,000 purchase price, 20% down. So you can see that your loan amount is $320,000, and if you remember on the buy downs, the cost of the buy down is based off the loan amount. So everything we're doing here is kind of based off the loan amount. And I kind of compared the standard loan. You can see a 6.5% interest rate. If you look at the standard loan, the base rate is 6.5%. That's what you start out with. The payment's about $2,022 a month, and that's it. Okay, you didn't pay anything extra for that rate. We didn't have a buy down, so there's no additional cost to the seller or the buyer. Okay, and you can see there the total overall monthly payment. If we go to a standard loan with points, so this is where maybe you paid to get a little bit nicer rate, right? So it's a permanent buy down. The rate never changes. And in this case, I showed approximately 2 percentage points that you paid in additional closing costs. It's about $6,400, $6,400 that either the buyer or the seller contributed, or maybe some combination of both buyer and seller. Okay. And you can see if you zoom down in the column, the payment's lower, $1,970 a month. And that saves you about $52 per month. Okay. So $52 a month, not a lot. It costs you $6,400 to do it. And so if it saved you $52 per month, it's going to take you about 123 months or about 10 years to recoup the cost on that loan. And if you refi the following year, you kind of lost your $6,400. You didn't make much of your $6,400 back in interest savings. Okay. Now, if you live in the loan long enough, if you live in the house for the entire 30 years, you are going to save money with that. It's just going to take about 10 years to recoup the cost at first. The 2-1 buy down is what we're talking about here. So this rate starts at 6.5. Okay. So we're not buying the rate down necessarily, but we are doing the buy down. The buy down cost in this scenario, if you zoom all the way down to the total buy down cost there, is about $7,283. So this is what it would have cost the seller most likely to contribute. Okay. So instead of coming down on their price, $7,200, they may go ahead and agree to do a buy down and contribute $7,200 to this buy down. And you can see that the first year rate then, if you go back up to the top under the 2-1 buy down column here, is 4.5%. So that's the first year. The first year you're going to pay 4.5%, and that's going to save you about $401 per month. That's $400 less in year one than you would have paid in the scenario with the standard loan. Okay. In year two, though, the rate goes up a little bit, okay, to 5.5%. So 5.5% in year two, that's still going to save you about $205 per month. Okay. And then in year three, finally, the rate will return to 6.5%. Which is the rate, the base rate that we started with. Okay. And so you can see in the year one savings column down below on the buy down, you saved about $4,814 in year one. In year two, you saved $2,468 in year two. And so the total, when you add those together, about $7,283. That was your total savings by going with the buy down. And that's exactly what the seller contributed to get the buy down in the first place. Okay. And again, if you refinance or you sell the house or something within that 2 years, part of that buy down is refunded to you. And you can actually apply that to the principal. So you're never really losing anything here. It's just allowing you to pay a little bit less in those first 2 years. That's really what we're after there.
Awesome. Thanks, Pete. I think the 3-2-1, the 2-1, or the 1-0 buy down really sounds like a very interesting tool available to both buyers and sellers that has a lot of applications that can feel really positive in an environment where interest rates kind of hurt.
Yeah, absolutely. It takes a little bit of the sting out of it for sure.
Yeah. Hey, thanks for joining me today. If my viewers have any questions or they'd like to talk to Pete about specific questions on loan products, mortgage loan products, you can find all of Pete's information down below in the description box of this video. Thanks, Pete.
You bet. Thank you.